Hello. You're watching exclusive coverage for U.S. jobs data prepared by Windsor Brokers. Markets are waiting for a release of the key event of this week, U.S. jobs report, which is due tomorrow on Friday, and generally expected to give fresh signals about the strength of the U.S. economy, as well as direction signal for the U.S. dollar and its major counterparts. The events started basically on Wednesday, as 3 days of strong data from United States are going to culminate on Friday on employment report for September. The events started on Wednesday, as I said, with the ADP private sector jobs report, which came well above expectations in September. If we take a look at the chart, then ADP reports, private sector reports, showed the ascent in past 3 months, diverging from the non farm payrolls data, which were in descending mode since June, but this time fell well below previous release, which was around 229,000. This time was 135,000, but beat the forecast of 125,000, showing that increase in private sector was quite strong in September, despite fears that job sector would have been hit by recent hurricanes that hit Texas and the region, and caused a lot of damages in the economy of United States. A release from August was also revised lower to 228,000 from initial release at 237,000. Another important release that that came out on Wednesday was report from U.S. manufacturing non-manufacturing sector, when the PMI report showed upbeat results in September, coming at 59.8, which is the highest since August 2005, and also heavily beating the forecast at 55.5 and the previous month's release at 55.3. Non-manufacturing sector presents the biggest part of the U.S. service sector GDP, around 80%, and significant results on Wednesday for September signal that U.S. economy is standing on firm and strong legs, and further recovery is quite likely according to the recent releases. Another important event was the speech of Fed Chief Yellen, who spoke in St. Louis at the banking conference. Despite expectations from markets that she will talk about economy or monetary policy, as most of market participants are waiting for firmer signals about next steps of U.S. Central Bank and the possible rate hike, most likely in December's meeting. This time Yellen kept quiet about these two key subjects and did not mention in her prepared speech, did not mention anything about economy or monetary policy. On Thursday, the events continued. Weekly jobless claims, another report from United States, which were forecasted at 265,000 the previous week, surprisingly fell to 260K, and beating again the forecast, as well as previous week's report at 272,000, which is a good signal, as less people were filling for jobs, signaling that job sector is on firm ground. Of course, release of tomorrow's non farm payrolls data will be the key event and will show the real strength of the U.S. Job sector. However, we have to consider that recent hurricanes in Texas have affected the sector itself, and lower numbers are forecasted for September mainly due to these reason. Another important report was U.S. trade balance and showed that gap unexpectedly narrowed to 42.4 billion US dollars versus 42.7 billion gap forecasted, and again well below 43.7 billion dollars gap that was seen in July. Two speakers are due on Thursday. Also, FOMC member Harker, who is also candidate to replace Janet Yellen in February when her term finishes, and FOMC member George are also to give more signals about Fed's policy in coming period, as most of market participants are looking for next steps of U.S. Central Bank. As I said, looking for a decision on winding down the huge, massive portfolio, as well as rate hike, which is widely expected. It will be the third one this year, and most likely to happen in December's Fed FOMC meeting. Now, quick look at the chart showing that U.S. Non Farm Payrolls are forecasted at 90,000 in September. This is the lowest forecast for quite some time, and as I said, it's caused by recent bad weather in Florida and Texas, which basically affected the whole U.S. economy and affected, of course, the jobs sector, with less people being employed in September. Forecast is 90,000 versus 156,000, which was released in September. Some statistics can show us in numbers. So September forecast is at 90,000. Previous one in August was 156, while August release was forecasted at 180,000. Came lower than expected. Then in July we had 209,000 compared to 183,000 forecasted, but upward revised previous release to 231,000, which brings us back to this chart showing that non-farm payrolls are in descending mode in past 3 months, and most likely, if on Friday come at 90 or levels which are below 156 of the previous month, then it would be quite negative signal, and would signal a continuation of this downtrend which commenced in July. As said, ADP data are usually used as indication for non-farm payrolls report, but correlation between two indicators is rather loose, and not necessarily that one will follow the other. Positive release from ADP is seen as an initial signal that release from non-farm payrolls data could be positive, but not necessarily to be like this. So what we can expect in case of release at forecasted levels or even below, that would be definitely negative for dollar, but most of commentators agree that there shouldn't be a bigger firework after a release of US jobs data, as there are other important things to watch. US unemployment, which is expected to stay unchanged at 4.4% in September, is also playing a big role, but the most focus will be mainly turned on salaries, as average hourly earnings are expected to jump to 0.3%, to rise by 0.3% in September, which is a much better result compared to increase by 0.1% in August. This is a hot point for US policymakers, as stubborn inflation and quite low hourly earnings are still giving a lot of problems to policymakers in order to make decisions of further tightening of the policy, and this is basically the thing that mainly stops them from having more aggressive approach to the policy. A quick look at the charts to show where the dollar is standing at the moment and what could be expected. This is the chart of US dollar index, which shows the performance of the US dollar against its major world counterparts. The greenback is in steady ascent. It's been 3 weeks, fourth week at the moment. We are ending tomorrow the 4th week in firm bullish tone. When, as most of market observers saw as first initial signal of reversal, as we have a strong downtrend of the dollar index, which commenced from 10380, which is the peak of 2017, posted in early January, and bottomed at 1997 at the beginning of September. So steady ascent generated initial signal of a reversal. As we can see on daily chart, most of moving averages are now in the bullish setup and created bullish crosses, which is positive, a bullish signal for further advance. And if we measure the Fibonacci retracement levels, the price already broke above 38.2%. There was a previous few attempts above these levels. The first one was on 28th of September, then the following at 2nd of October, and finally on the 3rd of October, on Tuesday, there was a strongest move that spiked at 93.76, but failed to sustain a break higher and returned lower. So what we need is a close above this level, where the price now is on track for today to close and generate another bullish signal. In case of positive releases from US NFP data, we can expect more upside action of the US dollar and possibly stronger advance, which would be looking then for previous high of 16th of August at 94.04, and top of daily Ichimoku cloud, which is in descending mode. The cloud top lays at 94.52. So these two are quite strong resistances that the US dollar index would face in case of a bullish scenario and further extension higher. Previously, we had in past 2 days dollar in the defensive mode. Tuesday and Wednesday ended in red, when the most market observers said it's just positioning ahead of US Non Farm Payrolls data and squaring positions before getting a fresh direction signal from US jobs sector data release. And now the full effect of yesterday's non-manufacturing PMI data and ADP report showing that the dollar is back on track for further advance, as the bulls are again fully in control, although we can see from the chart that indicators on the daily chart remain in firm bullish setup and favor further advance. A similar situation is shown on a weekly chart where the euro is in the 4th week of the US dollar index, is in the 4th week of advance, and may extend higher as initial reversal signal has been generated. Of course, a lot of work at the upside is needed. We have also falling 100 days moving average at 94.42, which falls among those two barriers that I mentioned previously, for a break above to generate a stronger bullish signal. On the other side, the euro remains under pressure. Single currency is pressured since Monday after the political crisis in Spain broke out with the referendum of Catalonian independence, putting single currency under pressure. This was more or less expected scenario. Although the euro is holding so far, there is an initial range, bottom, basically base, somewhere at 117.20 zone. This marks Fibonacci 61.8% retracement of larger ascent of euro against the US dollar, which commenced from 108.39. Pardon, we are at the wrong levels, which commenced from 111.18 and peaked at 120.92. The Fibonacci level, Fibonacci 38.2% retracement lies at 117.20, and this marks a very strong support. As we can see on the daily chart, there was no firm break so far, despite several attempts lower. So the euro dollar is consolidating above this level. Range is narrowing, which is more or less a standard scenario ahead of big events in the markets, like tomorrow's US jobs sector report, and the report itself will give us a fresh direction signal for dollar and its major counterpart. So euro remains bearishly aligned. Techs on the daily chart are negative and see pressure building up for final break below 117.20, which could trigger a fresh acceleration lower and test of the base of daily cloud, which is around 116 level, and that will be another strong bearish signal in case the price slumps below daily cloud base. Then it could extend down to 115 zone, which is another important Fibonacci support. On the upside, we have these two strong rejections today. The day hasn't finished yet, but anyway, there is a long upper shadow of the today's candle, as well as yesterday's strong rejection at 117.87, which mark initial resistance for euro dollar. But more significant levels are falling 10 days simple moving average currently at 117.89, so it's approximately near yesterday's peak, and this is a first strong resistance. 10 days moving average since turned south is tracking the euro dollar's downtrend since 22nd of September, and now is acting as initial resistance. We expect it ideally to cap any upside attempts and keep pressure at the upside and at the downside, pardon. However, in case of any extension higher, we have next important barrier at 118.16, which is following the daily Tenkan-sen line, and daily cloud top at 118.53. This is our breakpoint at the upside. In case it's taken out, then this will be a good signal of higher base at 117.20, 117.00 zone, and a signal for fresh recovery of the pullback from 120.92 to the lowest posted on Tuesday at 116.96. So euro remains in a negative mode, but the range is narrowing ahead of US Non Farm Payrolls data, which are expected, as I said, to generate a stronger direction signal. And another interesting pair is dollar against yen. Again, we have quite a good signal of a narrowing range before the event. The dollar yen peaked at 113.25 last week, and several times it attempted higher, but without any success. However, on the downside, we have this ascending 10 days moving average, which is currently at 112.46 and offering a solid support that so far kept the downside protected and kept overall bias from a low at 107.31 in place. So we have several bull crosses of the moving averages, and another very solid support, 200 days moving average currently at 111.93, which is seen as the next strong point to contain any extended dips below 10 days moving average. What we can expect from tomorrow's release is that dollar would go higher in case the Non Farm Payrolls report comes in a better than expected way. Generally, the central bank, U.S. central bank, said previously that everything above 100,000 is acceptable and is a positive signal. So I would say that anything above 100 will be supportive for dollar. Now the dollar against Japanese yen showed quite strong signs of fatigue at 113 zone. It's holding between 112 and 113 for some time, maybe 1 week, without a clear direction, most likely awaiting US data to generate a fresh direction signal. Although many analysts don't expect a stronger action higher in case of positive release of US jobs data on Friday, I would say that dollar yen may extend up to 114, 114.50, which is our next target zone. 114.50 is the lower top previous one that was posted on 11th of July 2017, and then just below it, it's Fibonacci 61.8% retracement of the entire downleg from 118.66 peak of 11th of December 2016 down to September 2017 low at 107.31. So we have quite enough space at the upside. Also, supportive factor is daily Ichimoku cloud. We had the textbook break through the cloud when the cloud twist previously attracted this strong rally, and then first attempt failed, but the second one was successful. Exit on the upper side of the cloud was again a matter of time, but this doji with the long legs shows that the pair hesitated at this point, and then final surge higher to initial peak at 112.71, returned back to the cloud, which contained a repeated attack at the cloud top, and then resumption of the bull trend higher, which gives a quite good signal for bulls to resume. Of course, if fundamental data come at desired levels, meaning that will come better than expected, as this thickening daily Ichimoku cloud is continuing to underpin the action of euro-dollar. Also, the weekly Ichimoku cloud is offering quite good support as the price broke above 2 weeks ago, and is now on track for fresh highs after release of US jobs data. On the downside, as said, we have initial supports, daily Tenkan Sen line at 112.36. Then, as I mentioned, the 10 days moving average at 112.46, and our pivotal support 111.93, 200 days moving average, break of which would then expose daily cloud top at 111.37 and risk further downside. So two scenarios see upper one sees break above 113.25 for extension towards 114.50, and the negative scenario break below Tenkan Sen 10 days moving average and 200 days moving average for extension down towards daily cloud top at 111.37. We will be closely watching events on Friday, and we'll cover, of course, events. We'll cover all reactions on after release of US jobs data. Thank you for your attention.